brevity and clarity. I will have a couple of questions, and the rest of the committee will have an opportunity to ask questions. First, I'd like to welcome my vice chair on the Senate Banking Committee, Senator Andy Vajda, to the room. Two quick questions. One for the first two panelists who spoke to us, Ms. Molina and Mr. Leonard. Yes. If people don't have payday loans as an option, and there is an emergency that crops up where they need a couple $100s for whatever it might be, what is their alternative?
There are actually, I think, a lot of alternatives out there, some of which are credit, some of which are non-credit options. I think most folks would agree at some point when folks are overextended financially to a point that credit is not necessarily the answer. I'm actually very encouraged by the state's small dollar pilot loan program and the lending activity of Progreso Financiero, which is now a profitable company, is offering small dollar loans at interest rates that are still higher than I would like to see, but none with APRs above 70. There are pawn shops that are all around the country, and that while that there's a reauthorization bill going around on that particular issue, pawn is a much better solution for folks because it limits your losses. There's no debt trap associated with pawn. So pawn is a universal, it's available in communities all over the state, readily available, and that's a far better alternative. The Pew Research Institute did a survey of payday borrowers, and what they found from some focus groups that they did was that when they asked people how people ended up getting out of a sequence of payday loans. And what they said is either they had a cash infusion, a tax refund commonly, or some new source of income, second job. But more importantly, what they said is that they borrowed from friends and family, they went to pawn, they negotiated with a creditor. All of those things are the things that they said is the way that they got out of the payday loan debt trap. And more importantly, what they said is that they wished they had done those things at the outset of their lending sequence rather than after they had already suffered the financial harm of being in that sequence.
Thank you. Ms. Molina, anything to add to that?
No, the only thing I would add is that we often see clients looking at what the actual safety net is in their community, right? Looking at 211, trying to get referrals for different services that they need. So for example, in Carmen's case, which I shared, she had multiple loans, so another loan wasn't gonna help solve the problem, right? So at some point she had to cut herself off, and unfortunately it was years and years later. So now that she's unemployed, she's seeking work, she's going to the food bank, right? She's talking to her gas, water, and light companies.
Well, actually, the question was if there were
alternatives.
Yeah.
So
just
if there weren't.
Give me two quick ones without a story.
Yeah, so people are they're gonna go without, right? She cut off her cable, she's reducing her bills and dealing directly with her creditors. And, if you don't have friends and family, then you're gonna go without.
All right, thank you. Moving to Ms. Bailey, Mr. Merman, you spoke of tribal loans or loans from companies sometimes just paired with tribes. Would the CFPB regulations, is it your opinion, apply to sovereign tribal nations? And if so, based on what authority?
Yes, in my opinion, they absolutely would. The first reason is that the Dodd-Frank Act, which created the CFPB, is a law of general applicability. And when you have a law like that, as a general rule, it's going to apply to tribes, and federal government can enforce it against the tribes. There's a Ninth Circuit case called Donovan versus Coeur d'Alene Tribal Farm, which cemented this as the rule here in California. And it makes sense. There are only 3 exceptions to this rule, none of which I think would apply in the case of payday lending. One is where the law would interfere in some way with tribal government on intramural matters. This means matters internal to the tribe, like membership, inheritance, land rights, that kind of thing. There would be no intrusion on any of those things by the enforcement of this law. The second one is whether it would abrogate any rights established by an Indian treaty. And I have yet to see a treaty between the federal government and an Indian tribe with respect to payday lending. And last but not least, is there any evidence that Congress expressly intended to exclude tribes from the enforcement of the law? There's no express intent here whatsoever. And in fact, the CFPB, I believe, has indicated that it really intends for these regulations to apply equally to everyone and protect all borrowers against all types of lenders.
Thank you, Ms. Bailey. Mr. Merman, anything to add?
I agree.
Thank you. With that, other questions from committee? Chairman DeBobne. Okay. Who else has a question?
So for Mr. Leonard, so the Center for Responsible Lending that you're from, I'm sorry, you have the self-help credit union,
Yes, ma'am.
and do they have fees for bouncing checks?
They do. We do. Yes, although we do not have, we do have bounce check fees. We do not have overdraft. We don't allow overdraft as an option for our borrowers. We do have a low-cost line of credit that our members can apply for.
Okay, so if I bounce a check, for example, what's the charge to me if I bounce a check for the?
Well, I'm not in the operations side of our credit union activity, but I believe it's about $20.
Okay, so I could also see where that could lead someone into a debt trap as well. If they're paying $20 for a bounce check fee and then another one comes, and then I could see how that also leads to that type of a situation.
Well, it's a single bounce check is a confined activity. There is their ability to check your balance and know what your balance is. There isn't this continuing ongoing obligation that is associated with that.
So what happens if somebody gets into a chain of bounced checks?
Well, we provide financial counseling to our members. And I think that when our customer service representatives see a period of financial distress, they will make some outreach to our members. We also offer our members a whole variety of loan programs, including small dollar loans. They are underwritten so that not everyone can qualify for them, because we strongly believe that we're not going to make loans to borrowers who don't meet our underwriting standards and who don't have an ability to repay those loans.
And then is the percentage, the interest percentage, is that much different? Is it 36% level, or is it much lower?
As a credit union, our loans are capped out at 18%, and that's an 18% rate with no application fee for most of our loans.
Okay.
Thank you, Senator. Any other questions? Senator Morell.
Thank you guys for being here. I never heard what the actual default rate was on these
On payday loans?
payday loans.
Well, that's actually a really interesting question, which the CFPB has looked at. If you look at it on a loan-by-loan basis, and as you heard, with most borrowers who are taking out, who are in a sequence, say, of 10 loans, they're actually paying off 10 loans. Even if they end up defaulting on the last one, the default rate is actually only 10%. So if you look at it on a per loan basis, you see very low single-digit default rates on a per loan basis. However, if you track borrowers who are taking out payday loans over a period of time, which we've done in using the state databases from a number of other states, you see that borrowers experience on the order of between 30 and 50% of borrowers will experience a default on a payday loan over a 2-year period.
Yeah, I've got a couple of quick questions here for Mrs. Molina. You had mentioned that, my first question on second thought, when a person takes that first payday loan, what typically are they using that money for? And you can just give me 1 or 2 examples you've seen.
Well, there's some kind of shortfall between their income and whenever, they're going to get paid next. So they could use it for a number of things, but a lot of people use it for regular necessities, which is the big problem because it's fundamentally an income problem and not a credit problem.
So then the next thing was, you had mentioned, I don't know if you have empirical data for this or not, but it strips away their assets. It would seem to me they may not have a whole lot of assets. And so, especially because you don't use collateral on these loans. So what type of assets do you see being stripped away from them, especially since these are not collateralized?
Sure. Well, the biggest thing would be someone's income, right? Because their income is being stripped away, their savings, and then with the case of car title loans, I mean, they're cars, right? But I think in general that it really impedes people's ability to build assets while stripping their fundamental, livelihood, right? Their income from their livelihoods.
Thank you. Good answer. One of the things you had mentioned, pawn, you like, and that was one of the things, as you guys were both speaking earlier, if you don't have assets, you can't go to a pawn shop, correct? So
Well, if you have no assets.
Yeah, I see it.
But most families have something. There is certainly no question that at some point, families will have no assets.
And so what I'm concerned about, because some of the things I've read too, is if they actually go to a loan shark or some of these offshore companies that are doing loans now at even higher interest rates. So where's that? How do you balance that and reconcile those things? Because there are things that, laws that we do have to protect over the consumer. I know you want more, but I see eliminating this as not being able to pay your bills would be one thing. And then my second concern, if they need the money, where's that going to lead them? Because they've probably have already tapped out their relatives, I would say, and friends.
Well, I think that the key thing here is that the CFPB is creating a single federal floor for all sources of loans. And I think it's very hard to think that the CFPB is going to be policing local loan sharks. But I hope the CFPB will come up with means of addressing transactions that are occurring over the internet, wherever those companies are based. It does seem to me we can't simply leave the internet to be a refuge of financial lawlessness to conduct commerce and leaving consumers unprotected.
I agree, unless if it's in a different country, that's going to be very tough to rein that in. That's a big concern of mine.
Well, I think that the federal regulators have resources at their disposal if in fact the loans are being if we're using our banks and financial services networks, electronic networks, to help facilitate those transactions, much like we did with offshore gambling for a while, that we can in fact use those alternative networks to police what is illegal activity, even if it's occurring from offshore.
Thank you very much.
Thank you.
For answering my questions. Thank you.
Thank you, Senator Morell. Chairman DeBobney.
Chairman, thank you so much. Actually, Senator Morell asked several of the questions that I had on my mind, including consumer motivation and the default rate, and I appreciate those answers. What I did take out of this discussion is, I think, to me at least, an interweaving of causation and really the symptoms of really a bigger issue, which is socioeconomic inequality. And I think, it's often, I think, when we're having these conversations, this industry gets painted as the industry that created the issue with impoverishment or indebtedness. It seems like when you talk about these extreme examples of someone that's homeless living in a car, and then they get a payday loan, or they get in this case, a title loan, that person clearly should not have got a title loan. But that is not the reason that person was living in a car either. And I do find it somewhat of a dangerous comment to say that there's never been a payday loan or a title loan that has done someone a benefit. I can personally tell you, I could tell you a personal story where it would have done a benefit. So I think to have extreme cases like that are clearly something we should be trying to resolve to make sure that the regulations that we're striving for eliminate from the marketplace. But I also think it's a little bit unreasonable to say that no one's ever benefited from a payday loan or a title loan. I can clearly tell you that's not the case. And I think it's a little bit of a dangerous comment. But I would like to touch upon, obviously I think we need to look at these regulations in a perspective where we have the most vulnerable consumers in the marketplace that are obviously in many cases desperate. Not every situation, but you've highlighted that in a very, I think, eloquent way. What things should we be doing within this industry, not in a broad perspective of financial literacy, but at the point of the loan, at the point of the transaction? What more can we be doing to encourage financial literacy, to be giving more transparency, to be making consumers more aware of the situation they're finding themselves in and what the consequences of that will be from this perspective. Obviously, I've worked with industry quite a bit. I've gotten their perspective on this. But from the perspective of the four of you, what should we be doing in terms of leaving aside what's going to come from the federal regulations? In terms of the laws we have on the books right now, the products that are being offered right now, what more should be being done at the point of transaction to inform consumers, to give them more insight into what consequences will come from these decisions, and to make sure they understand what kind of obligations they have going forward?
Well, one thing I would say is that right now it's somewhat deceptive because people really believe they're going for a short-term 2-week loan, not realizing that oftentimes if you can't pay the entire loan back, you have to reborrow, right, to make it to the next period, and then you end up in this long-term cycle. So I think that's one thing in terms of how they're marketed, right, and being a little bit more clear that in fact it could be a lot more than 2-week loans. I mean, on average, it's a 6-month sequence. So that's one response. I don't know if you have something else you want to add.
Yeah, I was going to say that I think that, I mean, some researchers have done some experiments and I think found better results when the disclosures are more aligned with the actual experience of borrowers in terms of their patterns of repeat borrowing, so that it's not marketed as a $145 fee for one 2-week loan, but acknowledging that there either is or there's a fairly good likelihood that borrowers are not going to be able to repay. Short of that, however, I think that having a sort of a regulatory arrangement which in fact establishes ability to repay up front is a far more effective approach than that could be improved upon by improving the disclosures as well.
One final thing I wanted to add with regard to local jurisdictions is that the city of Sunnyvale, as part of their ordinance restricting new payday lenders from opening, they're also required to provide a local resource list to people to kind of say, here's some other places you can go, Sunnyvale Community Services, XYZ places. And then the San Mateo County Board of Supervisors, Supervisor Rhodes Jacob Gibson's office, when she was in office, she created an alternatives guide as well, which was widely distributed both with local agencies and other partners. So,
if you'd allow me one follow-up, I would also like to say, if you do have any research from any of your organizations that would provide any detailed studies to show how many of the consumers of these products, whether they be title loans or the payday loans, also have a credit card that they could have used, but for some reason decide not to, or have the credit card maxed out. I've been trying to find information on that with my committee, and I think that'd be interesting to see the comparison there. And finally, I would just like to ask, in terms of, we talked about earlier, the first speaker, and it came up a little bit today about really the debt trap seems to be people, not just on their first loan or second loan, but by the time they get to fifth, sixth, and seventh, and they really have this sequence of loans. Do we think that that is really, there's obviously a number of reasons to go into that, and underwriting plays, and verification standards and all those things play into, I think, what your goals are. But in terms of the reality right now, do we think a large percentage of those loans would have been better addressed if they had a product that was a higher dollar amount, hopefully a lower interest rate to go with it, but because they needed a certain amount of money, they had to get into a situation where they're taking 3 and 4 loans out? Or do we think that's just not necessarily the case?
I mean, I think there are two different issues. One is the question of repeat borrowing, in which is effectively the borrower is reborrowing the same $255 over and over again. That's one issue. And the second issue is whether or not borrowers are simultaneously borrowing from multiple lenders, which we clearly have seen as the case, which state law, as it's written today, currently prohibits, but the Department of Business Oversight has no ability to enforce that under its current enforcement tools. So those are two very different questions. I think as important as the overall amount of the loan is actually the structure of the loan. I think one fundamental question that we've had it here in the Capitol about raising the maximum loan amount for a payday loan, if we see these kinds of numbers in terms of repeat borrowing for borrowers who can't afford to pay back a $300 loan and meet all their other financial obligations, that we think if the loan continues to be a 2-week balloon payment loan, that's going to be exacerbated by a larger loan because they're not going to have the ability to pay off a $500 loan in just 2 weeks. So I think one of the things that's really important is getting away from the balloon loan to an installment loan, perhaps, that is underwritten according to ability to repay, that gives borrowers both the time and the ability and is matched to their level of resources that will make it an affordable loan for them.
Thank you, Mr. DeBobne. Move now to Vice Chair Videk.
Thank you all, and those stories were very, very compelling, and I'm listening very intently, but I echo the chairman's the same sentiments. I mean, those are very extreme stories, but I can tell you, Mr. Merman, that probably 8, 9 years ago, I was a very satisfied customer, and so I know you were looking for one.
I ask people, and I tell you what they told me.
Right. So,
We're legal service providers. We're not seeing the people we're seeing.
okay, very good.
With that, I would like to thank this panel, excuse you from this particular discussion. Some of you may be back in the next series of panels. Now I'll invite up with a very different perspective our panel of industry representatives, Dan Gwaltney, President of California Financial Services Providers, Jabo Covert, Senior Vice President for Government Relations, Check Into Cash, Carol Stewart, Senior Vice President, Advance America, and Robert Grieser, Senior Vice President, Government Affairs, Community Choice Financial. Welcome all. As I said to the previous panel, you have 25 minutes as a group, so would ask you to each respect the other members' opportunity to speak, and we will begin in the same order in which you are listed on the agenda, with Mr. Gwaltney going first.
Thank you, Mr. Chairman. Good afternoon. My name is Dan Gwaltney. I'm the president of the California Financial Service Providers. Earlier, you asked all the people that are going to be testifying if any of them participated in the SBREFA panel back in Washington, D.C. last week, and I was one of those representing. I had the pleasure of being able to represent my company. We're a small lender, and had a chance to impart our experiences and our determination as to what we think the new CFPB proposed regs will do. So, and I'll speak to some of those later in my comments. Since the founding of our trade association in 1950, our members have been providing access to financial services to California consumers in the communities in which they work and live. Currently, CFSP members operate under licenses and permits issued by the Department of Business Oversight and the Department of Justice. Our members offer services such as check cashing, deferred deposits, installment loans, title loans, pawn, debit cards, and money transmission services. And we're grateful that the committee is giving us the opportunity to testify today on the impacts of the CFPB proposed rules on California. Our members are deeply concerned about the ramifications of the federal regulator in its proposal. After reviewing the CFPB's 57-page document, it is quite evident that the Bureau is attempting to fundamentally change the nature of small dollar lending in America. Short-term small dollar loans, such as the California Deferred Deposit Transaction product, are popular because they are simple, easy to understand, and convenient for customers. Unfortunately, the Bureau's proposed changes will eliminate these features. For example, the additional requirements under the ability to repay rules, such as running a Big 3 credit report, performing lengthy verifications of major obligations, and reporting transactions to all commercially available reporting systems, will make applying for a payday loan no different than applying for a car or a home loan. Applicants would be burdened with cumbersome paperwork requests, and certain customers who are cash-based and cannot document their expenses would be locked out. Moreover, the Bureau's underwriting cost analysis of these new rules ignores the added expense of validating all applicants, regardless of whether or not a transaction eventually is completed. This means that each funded loan must absorb the underwriting costs for those applicants that are not approved. The average payday advance in California is only $221. We heard earlier it was $260. You minus out the fee, the actual amount to the customer is $221. Factoring in the additional labor costs, the documentation and verification costs, it is clear to see that the requirement to do this level of underwriting is not financially viable. If it was, we'd see the banks doing this. Look at the 2013 California Deferred Deposit Annual Report, and it's a stretch to conclude that lenders are engaging in inadequate underwriting given that loan loss rates are just 2.8%. I think someone asked that question earlier. As for-profit enterprises, lenders want to get paid back and therefore do not extend credit to customers that cannot afford to repay. If we step back and look at the underlying premise of the Bureau's proposal, it is believed that the payday loan customer does not gain any economic benefit from the liquidity provided by the use of these loans. In fact, the opposite is suggested, that the sequences of short-term credit actually harm consumers. This theory has led to the proposed short-term alternatives with mandatory 60-day credit denial periods. However, the Bureau has not provided any scientifically based analysis of the claim as required by law and is attempting to do a one-size-fits-all approach. Missing from their proposed rulemaking document is any reference to various state law protections. Experiences in one state may differ dramatically from another. Furthermore, one would think that if customers are experiencing tremendous difficulties with this form of credit, it would be indicated in the level of complaints. Out of 12 million California transactions last year, the Bureau only received 510 complaints. 510 out of 12 million. This isn't even 0.1% of the deferred deposit transactions conducted. So what will be the effect on businesses in California if the proposed rules are adopted? Simply put, small businesses will not be able to make it. There are 297 licensed payday lenders in the state of California. Over 90% of those companies are small businesses. Referencing the table on page 45 of the CFPB proposal, the Bureau projects large companies will experience between a 60 and 75% drop in revenue if these rules go into effect. A recent Charles River Associates study analyzed 234 small business locations and concluded that they'll have a more severe drop in revenue of 82%, and 84% of the stores surveyed became unprofitable based on these rules. Unfortunately, my company was one of these surveyed. Frankly put, my company will not stay in business if these rules go forward as is. Our 93 employees will need to look for new jobs. Our 25 landlords will have vacant storefronts, and most importantly, our thousands of customers will lose access to financial services that they need. Now, if you extrapolate this to the 280 licensed small lenders and 17 larger lenders in California, collectively that operate 2,058 locations, you'll see the overall economic impact. Finally, the effects of the proposed rules on California customers will be quite dramatic. Since the CFPB has not taken into consideration the lack of other small dollar alternatives in California, most of the $3 billion in annual regulated payday loan credit will become unavailable. Most customers will simply lose access to the legitimate lenders and turn to the unregulated black market. We ask that this state legislature inform the CFPB that their proposal will hurt our customers and our licensed providers. Please request that the Bureau slow down, do required analysis, and thoroughly come up with targeted consumer protections that help small groups of customers that need them, but not harm the majority that use small dollar loans responsibly. Thank you, and I'll take any questions at the end.
Thank you. 18 minutes left for this panel. We'll move to, let's see, Mr. Covert.
Mr. Chairman, members of the committee, also Mr. Chairman Dabney, my name is Jabbo Covert. I assume I'm the only person named Jabbo from Tennessee in the committee room. I am Senior Vice President for Government Affairs for Checking to Cash. We operate 175 locations with 500 employees here in California. We proudly offer a range of financial services, including short-term, small-dollar loans. I really appreciate the opportunity to have us talk today. What I want to do is give you a little political background, Mr. Chairman, on where we are with the CFPB. In 2010, Congress passed legislation that we commonly call the Dodd-Frank Act. And following your rules, we can now call it CFPB. Enacted in response to the 2008 financial meltdown, this reform legislation empowers the federal government to centrally manage the risk of the American financial system. It was designed, as we all saw in the press, it was designed to prevent another financial crisis, another housing meltdown. The legislation gave birth to the CFPB. It's a new agency. It's got over a $600 billion budget that it gets not from tax dollars directly, but from the profits of the Federal Reserve. It has no congressional oversight for its budget or its policy. To date, the CFPB has already created nearly 400 new regulations, According to the data of the American Action Forum, it has imposed more than $20 billion in new compliance costs on businesses in America. These regulations have weighed much more heavily on small businesses and small banks than the larger companies that are able to absorb it more. Not surprisingly, many of Dodd-Frank's costs have already been passed down to consumers in the form of higher bank fees and reduced services. Meanwhile, the FDIC has estimated that the number of unbanked consumers in America has risen since the beginning of Dodd-Frank by over 1 million customers. So we have more and more customers being forced out of traditional financial services. We have seen growth in payday lending, check cashing, and other services since then. So those customers have been coming to us in a response to new regulations. Now we see new regulations to regulate our products. We continually keep pushing customers around from one financial product to the other. And again, are the customers really benefiting if we keep moving them from existing legitimate products? Regulations on credit from the CFPB have to achieve a delicate balance, and that's what we're in the process of doing. They have to enhance customer protections, but they have to preserve the access to credit. In order to do that, we have to have fact-based research. And not anecdotal, not conjecture, not blogs, not rumors. We need facts. And today, the CFPB, to our knowledge, has not conducted the necessary research to determine consumer welfare on products like payday lending. We're aware of 2 things that they quote, and they're from 2 well-funded lobby organizations. There's no independent research that we've been informed of. The CFPB examination of the short-term credit industry thus far has been conclusion-rich and research poor. For example, the CFPB is certain that consumers are harmed by short-term credit products, but yet they've not established that information by any sort of rigorous research. All the while, the Bureau appears to ignore research that supports conclusions that short-term credit products actually enhance the welfare of customers. Our industry is certainly willing to entertain reasonable reforms to the payday lending industry that are consumer-focused, but these reforms need to be supported by real data. We've talked about it already, Chairman Dabney. The economy is starting to grow a little bit, but income inequality continues to grow. Millions of Americans are living paycheck to paycheck. Millions of customers lack traditional banking services, and yet we continue to want to try and limit more and more services. It's important to remember we already regulate products like payday lending in California, already one of the stronger regulation laws in the country. You limit how much we can charge. You limit how much we can loan. And by the way, those limits have not gone up in 19 years. You've not passed any substantial legislation to amend either those limits in over 2 decades. Legitimate companies are already subjected to audit and enforcement actions all across the country, whether it be by state or existing federal entities. If the CFPB wanted to protect its customers, it would consider a real-world impact on the rule and how it would affect our customers, how it would affect our employees, and how it would affect the business going forward. I don't know that any of us really feel that our banking system is more safe or secure since the establishment of this legislation in 2010. Instead of tackling and solving the hard problems, CFPB is currently focused on $200 loans taken out by middle-class taxpayers. All the experience suggests that when legal choices are restricted, people are going to turn to illegal choices. The demand and the desire for credit doesn't go away just because we pass new regulations. Loan sharks, racketeers, they'll all be on the comeback if we continue to take away those options. So we'll continue to work with the federal government. We'll continue to work with you, Mr. Chairman, and we want to have some reasonable regulations on the products to allow us to serve our customers. Thank you.
Thank you, Mr. Covert. About 13 minutes left for the panel. Ms. Stewart.